Today, me and Mike are going to speak to the subject that is when investors invest, most often they only look at the past when investing in the future. They don't take what's going to happen in the future into an account. Mike, with all your years of investment experience, you must have seen this a million times.
Maybe 2 million times. It's so common.
I thought I was exaggerating.
Not at all. If it weren't for people focusing on the recent past in their investing decisions, I wouldn't have made as much money as I have.
So should we just stop the video right now? So you
No,
keep
because
making
I'm
money.
gonna tell people this and how it works, and I know that maybe 3 or 4% of you listening are gonna do what I suggest. The rest of you are gonna keep making the same old mistake, and that'll allow people like me to keep making money.
So
God
let's
bless you.
actually, first of all, thank you guys. Keep doing what you're
Yes.
doing. I appreciate it. Uh, but yeah, I was reading the book Your Money, Your Money, Your Brain, an investment book that Mike recommended to me. He talks a bunch about habits, dopamine, all of this. Gonna get into that either in this episode or next week. But he also talks about if you just look at the past, just think about if you look 150 years ago, maybe 200, there was no car. How much some things disrupt industries, and you can't imagine that. If you were born 200 years ago and I told you what a car was, you'd be like, what? What's that? Best thing ever. Which is another thing you need to be aware of. So, how do we actually take the future into account, Mike? I have to ask because we can't know what's going to happen unless at least I would make more money than I do, and you would also.
Yes. So taking the future into account, the very first step is to think back a little bit to the most recent events that have caught your personal attention, whether this was wars or a specific stock went up real fast or went down real fast or something. Something in the news and the media recently caught your attention. And realize that when people take recent events and project those into the future, that is a thing that we call recency bias. That is the most recent thing that happened in our brain. Then all of a sudden we think that thing is going to continue. A prudent and seasoned and experienced investor will stop their brain right there. Just let that thought go right out of the head. Because if you're looking at things that recently happened thinking they're going to continue, a lot of other people are doing the same thing. And whatever investments would go along with that thing happening, everybody's buying. So the price is up. It's not a good deal. You need to look at for things that haven't happened yet. That's how you start to train your brain to see future possibility. So the example of the car, there was a massive industry. People making carriages, wheel makers, whip makers, saddle makers, all these things around horses. Plus, there was a whole industry of people that were in charge of cleaning the streets after the horses went through. So a lot of this stuff going on. And had you, and there were in that day investors who were thinking very future forward thinking. You would have thought, well, we're always going to need to clean the streets, regardless whether it's horse poop or something else. Streets get dirty. So investing in things that are going to continue to make street cleaning faster and more efficient, that's probably a good idea. You would think to yourself, well, at some point, the horse isn't going to be sufficient because our population is growing. More people are living in cities now than there used to be. So there's this shift away from the country life. And you would have seen that starting to happen 200 years ago, a little bit. You would have seen a little bit, and you would have thought, well, okay, maybe I need to invest in other sorts of things like who's going to be publishing pamphlets and books, who's going to be providing communication. What's that going to look like? Is it going to continue to be a runner? You pay a kid some money and he delivers a message for you, or is that going to evolve? So that's how you start to think about what's in the future. It's like
A
take what's
question,
happening now and then see what's not being done yet.
yeah,
Yes, you
a
had a question.
question, yeah. To take this into a current example, for example, right now we have a huge change in how we should be driving electric cars. Everything should
Yes.
basically go electric. If you agree with it or not, it's on the Western world's agenda, big time.
Yes.
So, would it be a good idea to invest in a mining company that specializes in lithium at the moment? Based on that information only, of course, do your own research. We are not financial advisors. We haven't said that yet.
Yeah, we're not. We're not. Um, so with lithium batteries, the question then you would want a prudent investor would want to ask these questions, and we've already been asking them, as I'm sure you're aware. What alternatives exist to lithium? If, for example, you weren't able to get lithium out of the ground, what could you replace it with? So you want to look at what are
Biofuel
alternate
could be an
parallel
example here.
technologies that could be used. Yeah, maybe biofuel. Um, I won't make the joke about politicians all over the world run on biofuel, but anyway, I
What
won't
kind
make
of
that joke.
biofuel is that?
So yeah, you would look at lithium companies, you would look at disposal companies. We know that when an electric battery gets used up, it can't be recharged, it can't be rebuilt, it can't be remade. So where's all that stuff going to go? So you'd look at, okay, who's got the ability, who's developing the capacity to be able to store all that stuff? You can't recycle them. What are you going to do with them? Then you would look at, are there companies developing technologies that would create a rechargeable electric battery that never wears out? That doesn't exist right now, but think about if somebody could invent it, what that would change for electric vehicles. So these are some of the things you'd look at. You'd also want to look at who's making the tires. Are these things going to continue to run on rubber tires, or is there going to be something new? I mean, somebody creating some sort of other tire material. These are the kinds of things you would ask relative to electric vehicles. Also, what is your consumer going to be able to afford? There's many ways to look at that. It's a complex question. But the base core is, are you going to get people to buy these electric vehicles? As we just saw, we've had a massive ice storm in the United States. And in one particular city, we have literally over 1,000 Teslas sitting on the roads because it's so cold, they can't charge them right now.
I don't know
Now,
how
that's
they
a unique
drive that
event.
many Teslas in Norway. They love Teslas up there.
Yeah. So, I mean, it's a unique event. Hasn't happened before. How many of those unique events need to happen for people to say, well, maybe I should stick with my hybrid or my gas powered vehicle for a while? Well, all these things come into play. But the big investment opportunities are the things that nobody sees coming. The jet car runs on hydrogen fuel, it floats around like a balloon, and you have a propeller in the back, you steer where you're going. Doesn't
Sounds
exist yet.
dangerous.
Sounds very dangerous. It probably is very dangerous, but you want to look at what are things that haven't happened yet and who's developing these things.
So, what is, because one of the ways is definitely get a question. For example, like I just asked about lithium mines, and then list out what is all of the factors including in this. So, what could replace it? Who is going to recycle this? What are we going to do after? All of these questions. But how would you go about finding that first question so you actually can point yourself in the direction? Because I've found when starting with anything, like a blank canvas, when you have nothing on there yet, it sucks.
Right. You just got to you got to think of yourself like a painter. Just start somewhere, put a dab of paint and get going. In the case of mining companies, the first thing that we looked at was who are the big mining companies around the world? Mining has been around for thousands upon thousands of years. It's what we call a mature industry, meaning that there's a lot of development that's already happened. So you want to look at who are the big mining companies and what mines do they own and what mines are they leasing from someone else. As a specific example, there's one lithium mining company that owns mines that they lease from the government of the country where they're operating. If that government decided to shut them down or give the contract to someone else, that company is going to lose value. There are mining companies that own their own mines, which is a much safer investment because when they own their own mine, they're no longer at risk of having it taken away as much as they're at risk of not getting the stuff out of the ground in an economical manner. So we looked at who are the big companies, who's in competition with who, and how much mining are they doing. So for lithium specifically, how many tons are they taking out of the earth every year? And out of all the tons of lithium that they mine, how much of that ends up in electric vehicles? Because there's mining, there's processing of the ore that comes out of the ground, there's shipping, and there's all kinds of things that can go wrong. And every step in the process, an investor needs to ask, what would be the worst case at this step and what would the results be? So you build this idea of the future value of the company. And if you look at everything, it's called breaking the company is the term. If you look at every possible way that this company could be hurt and you add up all those numbers and they're still making money, it's probably a good investment. And never put your eggs in one basket. Our parents all taught us that when we were young children. If there are 3 lithium mining companies that you like, you buy equal amounts in all 3. Don't put it all in just one place.
So when you say that, I've heard other stock professionals saying they do the same thing, and then they analyze in the short term after making the investment which one to put more eggs into. Are you a believer in that, or should you stick with all 3 and just ride it out for the long term?
I say most people should stick with all 3 because most people don't have the temperament or the interest or the discipline to sit for 8, 9, 10 hours a day reading through all this stuff on a consistent basis. Most people will not do that. It's about as exciting as reading the list of ingredients on a package of food. You're reading this long list of stuff and you're looking for those bits of information that are important to you. But as you can imagine, when companies publish reports, they are reviewed by lawyers and they come out pretty much as confusing as you can imagine. Particularly the numbers bits, all the financial statements are done by accountants and then they're checked by lawyers. And by the time it gets to you, there's not a lot of English left. You really have to dig. So because most people won't take that kind of effort, it doesn't make sense to concentrate an investment unless you know something other people don't know. And this leads to a great deal of success. For example, if you were driving an electric car today and you notice something about your own battery in your car that you think most other people didn't notice, you might act on that. Because you might say, well, I see a future where this particular battery company that made this battery might be worth a lot of money because whatever came up with your observation. Then you could go invest. But otherwise, if you don't have some kind of insight like that, there's another great insight when I don't remember the name of the guy that was talking about. It was a radio talk show. A businessman was talking about the first time he saw an Apple computer. And he was just at a buddy's house. He saw the Apple. He saw it with its little mouse. If any of you don't remember, the first Apples they're kind of silly looking today, but back then they were very revolutionary. But he saw that and he said, that is the only computer that he had ever seen that someone could put in their house. So he went and bought a bunch of Apple stock. It was an observation other people could have made. He made it and acted on it because it was something to him. He felt it was something most people didn't realize yet. So that is when you would concentrate in a position when you think you know something other people don't know. And it has to be something that's publicly observable. Like other people could see it if they were looking, but they're just not seeing it. There are all around the world insider trading laws which apply to executives of companies. If you're in a position to affect the value of a company, you're not allowed to trade on inside information. Most people aren't in that position. Most of us are not running big, massive companies. So for most of us, that doesn't apply. But that's what you want to think about. If you're going to act on a piece of information, make sure it's something that you can observe, that someone else could also observe, and then you're fine.
And talking to that, one point that's very relevant, and I kind of hinted towards it, the intro of this episode is we are very emotional creatures. And we can very quickly get affected by the ups and the downs on trading platforms. There was another great example for the same book that I mentioned, Your Money, Your Brain, is he talks about how much more brain activity those stock forms with red and green and all of the nice colors and candles and everything flare up our brains compared to reading stocks out of the newspaper in black and white. That's very bland. That's just like reading, as Mike mentioned. The ingredients on the back of food packaging. Not interesting reading.
Yeah. Not really.
But seeing all of these nice graphics on the screen really affects you. So go ahead, Mike.
Yeah, they do that, and it's designed to get the emotions welling up. A successful investor should always look at investing as being about as exciting as watching paint dry on the wall. What you want in investing is not emotion. You want analysis, you want logic, you want forward thinking, you want imagination, you want visioning. None of this should involve emotion. Emotion will get you killed in the market. Where you want to place emotion is in your fun and dangerous pursuits that you do outside investing, like, skiing down a mountain or swimming with sharks or
don't do that.
Dangerous things.
Well, yeah.
That's where
the last one can be more dangerous than the sharks. Picking the wrong one so I can definitely think of certain women where I would rather jump in the ocean with sharks than in bed with them. At least I will have higher odds of surviving when we talk on very logical.
We use emotions in those kinds of pursuits because that's where emotions belong.
Yeah.
Always remember, money is totally does not care who owns it, does not care. Money does not care about you. People will say things like, well, I love my mutual fund. No, you don't. You enjoy your mutual fund's performance. But if you start falling in love with an investment, it's going to be really hard to sell it when you need to sell it. Because your brain will want to hang on.
It's funny you say that. It's apparently the same attachment from what you say as people make to their cars, because they think they are worth crazy amount of money when selling them. And they're not.
Exactly.
It's worth $2,000 worth above anything else in the market, and it's driven 20,000 miles more.
And this is a bias we see. And when I say bias, it's a bias in your brain. We don't control it. It's something that happens because we're human. We see it, and then we have to act to correct it. So talked about recency bias, where you extrapolate recent events into the future.
Yeah.
Another bias you have is the bias of not wanting to take a loss. So if you've held a stock for a while and it's not performing, and you're going to lose money when you sell it, you're going to take a loss. Sometimes taking that loss is the best thing you can possibly do, as opposed to hanging on to it. Where I don't remember who said this quote, that some investors are so successful that they'll ride a stock all the way down to zero.
Yeah, it's very true when you're saying it. Like, sometimes
and
good business is minimizing your losses, and that's taking the loss up front before whatever turns valueless.
I I had a really big laugh with the potential client. We ended up not doing business because our attitudes were radically different. But he said, "Well, you've made all this money," and I said, "Yes." And it was not a straight line. There was a lot of bouncing up and down to get here. Uh, sometimes you got to sell at a loss. And that's just, fortunately, most countries that have stock exchanges also have rules that let you balance a loss against a gain. So it's called tax loss harvesting. So if I lose, say I lost $20,000 this month on an investment, but I made 20,000 on another investment, I can call that a net zero and not pay taxes on the gain on the 20.
Even over
Uh,
here in communist Denmark, we have that.
yeah. I mean, that's something to realize when you take a capital loss is many times you can balance it against whatever your taxes were going to be.
Yeah. So that this is
I know,
more of a
small comfort, but
well, it's an advanced strategy, but it goes into selling strategically. Sell when you can get into the right tax brackets. Don't sell, especially in Denmark, you don't want to sell everything at once because that's going to require you
no.
to pay more taxes. If you take in a loss on another stock, you can sell more of your profitable stock that year because you have that loss. So take that money out if you are aiming to get that money out over the next 3 or 5 years to pay the minimal amount of taxes.
And I
Because let's
recommend
say,
is
just before I let you speak, Mike, let's say, for example, when in Denmark, the stock drops 10% when you then sell it, well, you're still going to be left with more money by strategically selling because you're going to end up paying 30-40% in taxes.
Mhm.
So that 10%, even though that's on the whole stock, not just the profit, might only be 20%. Well, that's still 10, 20% less.
And people, I see this over and over again. People will want to hang on. I bought that stock at price X, and I'm going to wait till it comes back to even before I sell it. You only do that if you have a really good idea that it's down because of other factors than the business. Sometimes a stock can go down because of all sorts of outside things that had nothing to do with the company. So if you're thinking to hang on to it, look at their sales. Have they lost sales dollars over time? Are they maintaining an even level of sales, or are their sales increasing? If their sales are still increasing, but their value's down, it might make sense to hang on because the company, as they make more sales, is becoming more valuable.
Exactly.
You always got to ask, why is it down? If you can't find a reason why it's down, that's an even better time to get rid of it.
I thought that was the time to buy more.
If you don't know why it's down, and you can't find any discussion anywhere about why it's down, that's a red flag. Something's going
Insider
on.
trading.
Or whatever. Which brings us to another point. Our friends that did crypto,
Mike,
sell
don't
crypto.
blabber on about crypto for 5 minutes, please.
I'm not.
I gotta
I'm
give
just
you
saying,
2.
This is the thing that ran on a lot of emotion. Buy crypto, buy crypto, buy crypto. I'm making money in crypto. That was the message. Don't buy based on emotion. That's what I was going to say about crypto.
Well, it segues into the last thing I wanted to cover. I love actionable, implementable steps. And we talked about emotion. I will lead off. One of the ways you can not be as emotional about your investment, I will stop hitting my desk so my camera is not shaking, is not checking your stocks or your crypto and your investments every day. Train yourself to check them as like least often as possible if it's long-term investments. What is your tip
Yeah,
for our audience, Mike?
really, it's what you said. And I would add, think about how often you look at YouTube, Facebook, TikTok, whatever you look at every day. The reason you keep going to these social medias and looking at stuff all the time is your brain's getting dopamine hits by going there. In the old days, before all that social media, people watched a ton of TV. It was the same thing. TV kept giving these dopamine hits, and people sort of stopped doing arts and crafts and creating and all these sorts of things that they used to do before TV. If you take that social media impulse that you already have, and you're human, so we all have that, and you start using that in investing, you will get absolutely killed because you'll start thinking you have to act, you have to act. Well, no, you don't. What you have to do now, because we're running a significant amount of money, we check all of our assets once a week, and that's it. It's once a week. It takes about an hour to see where everything's at. The rest of the week, we're reading, we're learning, we're studying, we're listening, but we're not checking specifically the performance. It's a performance check once a week, which is often enough for us. For an individual doing their own, you check that every month. Once a month is all you need to do. And what you're looking for are big drops. For example, if you have a stock and 1 month it's $100 a share, and you check a month later it's at $20 a share, you might get mad at yourself and say, how come I didn't check it sooner? Well, you don't know when that drop happened, but you take a look at that and say, is it time to sell this thing? Likewise, if it went up and now it's worth $1,000 a share, you're like, I just made 10 times my money in 30 days. Maybe I should sell some of that, take some profit. But these are questions you would ask yourself. So once a month is plenty for most people.
So with that being said, make sure to join our Telegram group down below, not for investment advice, but from what we learn when we read article on Fisher and watch YouTube videos and what we see happening in the market. It's just our reflection of what's going on, nothing else. But check it out.
Yeah, come check it out, and you're free to post questions in there.